good morning, and great morning, guys. Welcome to another fabulous episode of Exit Strategies Radio Show. Hey, I am your host, Corbin J. Millett, broker and owner of Exit Realty, Low Country Group in beautiful North Charleston, South Carolina. Guys, if this is your first time listening to this show, hey, you are in for a treat because our mission here is very simple, guys. That is to empower our community through financial literacy and real estate education, guys. We're legacy building here. That, as we've been saying for quite some time, as we encourage you all to do, when you're doing those things in your life, when you apply the knowledge that you're picking up, that you're gaining from this show, you on social media, put a hashtag on that thing that says that you're legacy building, because we want people to know that you're out here creating a legacy for not only for you, but for your family, for your children's children, so forth and so on, as we know our word tells us, right? So, guys, I got to give a quick shout out to those who listen to us faithfully in the Charleston market, who listen to us from one end of town to the other, from Hollywood, what you know, no good, all the way out there to Monkey's Corner. Y'all know my mama live out there, y'all. But I got to give a quick shout out also to our listeners in the PD, those guys and gals that's tuning in from the Mullins. Yeah, that's what we call it. Tuning in from Marion. Guys, thank y'all so much for tuning in and listening. And hopefully we're continuing to bring you insight and knowledge and concepts to help expand your financial outlook. We're here to change the game, guys. That's what we're going to do. And we're going to continue to do that today. Because we got with us, guys, look here. We got one of them. He ain't an FP. He is a FS. So a FS is a financial strategist. He helps you with a strategy and the concepts to get you further with your money. Because see, one of the things that we oftentimes are hindered by, quote unquote, or we feel we're hindered by, is our money. Our money don't go far enough, don't go long enough. But y'all ain't know how to talk to y'all money yet. When you know how to talk to it, then you can get it to go places where it ain't never been before. So today we have with us none other than Aaron Revere. Now, Aaron is going to blow your socks off. Okay. So I'm super excited for this conversation because anyone who know me know that I love these kind of conversations. So Aaron, welcome to the show.
Thank you so much, Corin, for having me.
So Aaron, if you could give our listeners, if you will, that 50,000 foot view of who you are and what you do.
Okay. So I have done almost everything you can in the world of real estate and finance. I've been a real estate agent. I've been a real estate syndicator. I've been a mortgage broker and an insurance broker. And I've been doing that since 2012. So in that time, I've always had one hat on at a time, right? The insurance broker hat or the mortgage broker hat or something. And so while doing that, I've been the product expert, as everyone tells you to be. But I came to see that there are these gaps. It's, well, if you combine what you know with insurance, combine that with mortgage, there are strategies and things that intersect where the customers or the clients are not getting that knowledge because you're talking to strictly a mortgage broker, right? Or strictly an insurance agent, or strictly whatever it might be, a wealth manager, right? I always like to use this example. If you've got tons of equity in your house and you want to know what to do with it, you ask your mortgage broker buddy, he's going to say, hey, maybe do a cash out refinance. You ask your real estate agent buddy, he's going to say, hey, you should probably sell that, right? Well, who do you believe? They're just promoting the one thing they got, that one license they have. But with me, what I've done since is put kind of four basic things, that's investments, insurance, mortgage, and tax strategies, under one roof. So I like to say that instead of being the product expert, which benefits the bank or the insurance company, I want to be the expert in the client and what they need and what's going to move the needle at the financial trajectory for their life.
That is huge. Basically, you've become, and I won't say a one-stop shop because that's not maybe the right connotation to put that in. But essentially, Aaron, what you've done is you've become more diverse in your expertise so you can advise people differently. So I can tell you that. Okay, I love that. One of the things you touched on as we were behind the scenes, behind the curtain in studio, if you will, exploring a couple things, because our listenership is broad, right? And the people that are listening, some of them are considering a mortgage, but they're afraid of committing. And I get this one all the time. I imagine when you were a real estate agent, you might have gotten this on occasion. Somebody would just tell you they feel they're too old to get a mortgage. But that's always impressive to me because I don't want to be paying for a house for 30 years. But you have, in your knowledge base, you have established and developed the strategy to help people considerably shorten the amount of time that they quote unquote have to pay on a mortgage. Am I correct?
Yeah, that's right. So for people who can qualify, and that's what I do is I qualify them, right? That's where I put my mortgage broker hat on. But there is a way that you can take a 30-year fixed mortgage, even if you got it yesterday, okay? And you could pay that off instead in 5 to 7 years. Now, the secret to doing that is the same secret to pretty much all financial things. It's all about income. What's your cash flow, okay? And the better and the stronger your positive cash flow for your family, for your household every month, the more likely you're a good candidate for that. If you
Mhm.
live paycheck to paycheck, that's going to be hard, right? It might not be doable. Although sometimes I've been able to take people who've got big credit card bills or they've got expensive insurance or something like that, and we're able to find some cash flow for them they didn't know
Mhm.
previously. But short version of it is yes, we're so used to thinking of the best deal in town is a 30-year fixed mortgage at a low rate, and that's great. But if you can pay it off in 5 to 7 years, if you can save yourself over $100,000 in interest, and by the way we do it, right, is that you can set up like an insurance plan on the strategy overall that when it's done protecting the strategy, it's going to set up a pension for you. So you actually have some retirement income, the thing that everyone talks about wanting to have or planning for that no one ever does. You know,
Mhm.
you actually have that set up for you. And so we can protect a lot of people that way. But more importantly, saving $100,000 in interest is great and exciting. But I think everyone seems to overlook how about getting your house paid off in 5 years? What if your house value became your down payment on your next house?
Oh, mind blown, mind blown. So the concept you're talking about, I forgot the guy's I think it was Nelson wrote a book on that. How to
You're
become your own banker.
describing infinite banking from,
Here you go.
I want to say Nelson Nash or something like
Nash.
that. Yeah.
That's and Robert Nash. Yes.
Right. Something like that. Yeah, there's a couple of guys who talked about infinite banking. That's actually not what I'm describing. Although that concept is there's some sound principles to it and some principles that relate to that apply to this as well. But no, the concept here really is what you'll be able to find it on the internet is mortgage acceleration. Okay.
Okay.
I was actually exposed to this strategy myself in 2015. And I was a mortgage broker at the time. And I brought this to clients and I thought this was great. And the mortgage acceleration piece is the piece that pays off the home in 5 to 7 years and saves the hundreds of thousands of dollars of interest. And again, I
Mhm.
was a mortgage broker, so I was in a great position to sell that to people. And I told it to people, but I couldn't sell it. You know why, Corwin? I couldn't sell it because people would ask me the key question. But this is great, but what happens if I lose my job? What
Mm.
happens if my business fails? Because I would tell them, just like I told you, the key part is that consistent cash flow, right? Positive cash flow, income. That's what matters. So they would ask me, what if it disappears? And the part of the strategy is where it doesn't seem to make sense to people is you're going to move maybe even, and I've taken people from a 3% loan, by the way, and put them into this strategy, which at least on paper, you're going to see somewhere there might be an 8.5, 9% interest rate. And right
Mhm.
away, people line say, there's no way this can work out. And they would be right, except we're working the balance in a whole different way. I would much rather pay 10% interest on $100,000 than 5% interest on $10 million, right? Because it's really about the interest expense, not the interest rate. But going back, so people would say, but what if I lose my income? Then I will be stuck with that higher interest rate and I won't
Mhm.
be able to move down the balance. So, like I said, like when I just had the mortgage hat on, I got stuck at that. I couldn't get people on board because I understood what they were saying. They had a good point. Since incorporating these four different fields under one roof, what I've been able to do with my partner's help, and we've been able to figure out a way to structure like an insurance policy, if you will, on the strategy overall. So if someone is in a good position on day one, right, and we'll evaluate them and they figure out, and we figure out that they're a good candidate, we can, with 98% degree of certainty, ensure that they're going to be able to do the strategy. And that
Okay.
makes all the difference. They're not going to be in a situation where, oh, I'm going backwards and now I've got that 8.5, 9% interest problem. And as far as I know, there's only one other competitor I've seen who's doing something similar to what we're doing on that front, where we're ensuring the process.
Interesting. That's a unique concept there, Aaron. What kind of the tells that someone could qualify or otherwise do this? What are the kind of the benchmark or triggers that you
Sure.
guys use to say this is something that they may be able to do and let's introduce it?
Sure. The number one kind of like benchmark to figure out is, and people should know this anyway, we're all guilty of not knowing our numbers as well as we should, right? But the number one thing is what I like to call expense ratio. So if you look at your gross income, and let's just take taxes out, so what you're left with after taxes, tell me what percentage are your expenses of that number. If it's 100%, then that's living paycheck to paycheck. And then there's no cash flow left at the end of the month to work down the balance to make the strategy work. However, if someone's probably a good candidate, if they're like, yeah, my expenses are about 80% of what I've got after I pay my taxes, that's probably someone who's good. So whatever that might be, it also matters on how big of a loan do they have, right? Without getting too much into the weeds, if after taxes they're making, simple numbers, $10,000, if their expenses are 8 and they have positive cash flow of $2,000 a month, that is a very good sign that we're talking to someone who could be a candidate. And again, if they're not a candidate for that, we still have all the typical mortgage options available to them. But I just want to be able to offer them the fastest payoff with the least amount of interest paid overall.
What you work to do is allow them to create essentially the snowball effect on their mortgage. There's other financial people that talk about snowballing debt. You pile the higher interest, you pay the smaller balances off and keep recycling the money. So it is paid off. And then I go over here and I snowball the next one and so forth and so on. So essentially you're teaching people out of the gate to attack the mortgage, to snowball it, to keep paying and pay and pay. So that way you can eliminate the interest and apply more to the principal and reduce it at such a rate that it allows you to get it paid off in a much shorter period of time. I love that. Love that concept.
I'm just going to add one thing to that, Corwin, and that is speaking to the snowball and the debt snowball, which you described. A lot of people, if they have credit cards or they have a car loan, one of the first things we do is we bring that debt, we bring that under the mortgage and that's not complete rocket science, but the reason you got to do that is because there's no better loan than a residential mortgage in America. It is the best loan in town. So let's start with getting the cheapest rate to begin with. It's going to be cheaper than your car loan, certainly cheaper than credit cards right now because of how interest rates have moved up. Okay. And that sometimes is, by the way, how we're able to find cash flow for people. And when they think they don't have $2,000 positive cash flow, if they own a home and they don't need a ton of equity in it, but they got to have some, we can make it happen for them. We can find that cash flow.
I love that. I love that. So you all work with the gambit, obviously the person who's looking to purchase a residential property for occupancy. You work with investors as well. So let's shift a little bit further down, if you will, down the line, the spectrum, if you will. And what strategies are you employing for your investors? What does that look like? What are you recommending now, probably more so than anything else?
So in our company, we offer, again, investments, insurance, tax, and mortgage strategies. On the tax strategies side, what we're doing on the tax strategy side is for people who have, let's say, greatly appreciated real estate. Okay. Right now, if you're in the market, if you're looking at selling a property, you might not feel like now's the right time to buy another property, right? Because we can always do a 1031 exchange, right? That's a tax deferred exchange. But maybe you feel like that's not the right move for you. Maybe it's a great move, but there's just even bigger opportunity elsewhere. Or if someone's got a business that for most people, they started a business basically from scratch. And now they've reached an age where they're going to sell their HVAC company or they're going to sell their physical therapy business or their accounting business, something like that. We can help people basically eliminate those taxes. This is a strategy where certainly it's got to be like the juice has got to be worth the squeeze type of thing. But for someone who, let's just say, is looking at being taxed on, let's just say $1.25 million gain, but let's say, which is not so hard if you started a business from scratch. You're going to sell your business for $2 million, but as far as Uncle Sam's concerned, you started with a $100 basis, So you're basically looking at the whole thing is going to be subject to tax. So what we can do there, and actually I like this part, Corin, because it involves a little charity. So we can also be good with our money too.
Okay.
What we can do there is we can set up we like to call it donor advised fund, but basically it's an LLC. And it's a regular LLC. It's not a special LLC. It's not a charity LLC. It's not a charitable remainder trust. It is an LLC. And what we're able to do is we're able to take the person who owns the real estate or they own that art or they own that business and they're going to form this LLC. They're going to be a 2% owner. 98% of that ownership is going to be a charity or charities that they like, that they care for, that matter to them. That's going to be the ownership structure. However, they, the donor, are going to have 100% voting control over this LLC. You're going to donate that asset, that real estate, that business, going to donate that asset to this LLC. The LLC is going to then sell it. And so then all the funds from that sale are going to come into that LLC's bank account. And the donor is going to pay the taxes on the 2% that they own. They're not going to pay 2% taxes. They're going to pay taxes on the 2% that they own. The rest of the sale is basically the charity sale. And charities has to be a real charity, but charities are tax exempt. That LLC can continue to live. That LLC can go do business. that LLC can go do business and can go buy real estate, can go buy business purpose stuff, buy real estate, buy collectibles, buy a new business. And you can set up a structure where something like 5% of the net profit from that new function is going to profit the charity. But the rest is the donors. It's their money. Now, let's just say, though, the guy or gal is looking to retire and they really wanted to buy a vacation home with the money that they sold their business from. What they can do in that case is, again, this is where we help them, but basically they can borrow the money. It's not a business purpose now, so they got to borrow the money out of that LLC structure. In order to borrow that money and to make the IRS happy, because none of this matters unless we make the IRS happy. So the way to make the IRS happy is that we have to post some sort of collateral. Okay, we have to post some sort of collateral for the business owner to now borrow that money out. And the way they're going to do that can post cash, but that kind of defeats the purpose if they have the cash, right? They can post real estate, but that gets complicated because a lot of real estate's got a mortgage on it, right? So that can get complicated with liens and whatnot. And then the third thing they can do is they can establish a permanent life insurance policy where the charity has to be listed as the beneficiary. So because they have a permanent life insurance policy where the charity is going to get the death benefit, that pledge is locked in, that counts as collateral, and now that business owner can borrow that money. As you can imagine, making premium payments on this life insurance policy is a lot cheaper than having to come up with the cash, the collateral cash. And so this is how we're able to help someone sell their business, sell their greatly appreciated real estate without having to deal with the taxes. In a large way, we're able to eliminate a huge chunk of the taxes and, again, stay compliant, because if we don't do that, then what's the purpose?
Man, look, you just messed me up. Yeah, I get track on all of that. And in my mind's eye, I'm like, that is ingenious. Yeah, the concept is awesome. And the tax benefit it's almost a no-brainer.
The tax benefit's huge. I like that also that you can help a charity. Charities, I bet you do too. I know a few charities, and I know that when times are tough, their times are tougher for them. And so they struggle to raise funds, and they're having conversations with their favorite donors all the time. And so what I like about this is I have gone to some of my favorite charities and I've told them about the strategy and said to them, go tell your donors who maybe otherwise would give you a check this big, but they've got real estate, they've got a business or something like that. And I'm saying to them, let them know about this. Okay, let's get a pledge for you of some serious money that is going to come in.
Wow. So, Aaron, we've touched on across basically everything that you guys do in all buckets, because what you managed to do is really like peanut butter. You can spread it out across all sectors: real estate, mortgage, insurance. You spread it all across every background. So the investors that you're working with, are they leveraging this in primarily real estate holdings? Are they leveraging in perhaps art or other tangible items? How do these concepts play out at the greatest and highest levels of success that you've seen?
So I definitely have a lot of real estate investors, and real estate investors they have a good amount. Real estate's great, right? This is why I started in real estate. Real estate has a lot of options to it. You've got 1031 exchange. If you're going to keep the property, you can do accelerated depreciation and all these different tax strategies to try and keep your taxes as low as possible. Now, I do have real estate investors who are doing this because they maybe feel like at different times, whether it's the end of a legacy and they're just not interested in playing the game and the kids are not the real estate investors, they're into tech or something, then they're just real interested in kind of winding down the real estate portfolio. Sometimes they're not. Sometimes, again, speaking to good tax advantages of real estate is they're just going to hold on to that real estate and they're going to pass away and their kids are going to inherit it and get a stepped up basis. So also a good tax strategy. So I do have real estate investors, but they also have a lot of options available to them. The people who I'm talking to a lot are people who have done really well with either stock investing, crypto investing, stuff like that. I'm talking to people who are selling a business is very common. People are realizing that they don't have to just shut the doors and they actually have something of worth. So there's people realizing that they could sell their business or sell their book of business or something like that. And I'm talking to people who have done very well in, let's say, the e-commerce space, but also some people I'm talking to about, for example, the donor advised fund strategy I just told you about a moment ago. It can also work for people who are just making a strong income, whatever it is. I can't think of all the different ways of making money in today's day and age. So it seems like I'm figuring out new ways people are making money every day with technology and everything. But if someone's making, let's just say, pretty consistently $500,000 or more. Maybe they're a doctor, they're a successful surgeon, or maybe they're a successful lawyer, something like that. If they're pretty consistently making over $500,000 a year, then you could do the same donor advised fund strategy. I can do it with them and their income as well. It doesn't have to be the sale of an asset. It doesn't have to be a sale. It doesn't have to be a transaction like that. It doesn't have to be a real estate transaction. It doesn't have to be an art or a collectible or the sale of a bunch of crypto. It can even be someone's income. But for all the costs and the expenses, because as you can imagine, there's tax attorneys and we got to make sure it's compliant and whatnot, it becomes worthwhile if that person knows that they're going to be making $1 million or more in the next 2 to 3 years.
So a couple of things for you, Aaron, because one, we're getting pretty close to the end of the show. So I'm really intrigued by, and I'm definitely going to be playing around and looking and researching and reaching out. But how can people get in contact with you? Do you teach, train? Obviously, you're working with clients that are in this space and in this arena. So how can people connect with you to get more information or for additional questions?
Got you. So the simplest way that I've set up right now is that people can go to hello.ashtonkent. That's the name of our company. So that's ASHTONKENT.com. So you can go there. And that's just maybe the quickest, easiest way, because then you can get right onto my calendar. You can see a video of me. I have a description of a kind of a longer description than what we were able to do here on the show of that mortgage strategy, for example, because that usually piques people's interest. So they can go there. Other than that, the best phone number for me is the office work number, which is 561-421-0210. And we're East Coast and we're typically open 9 to 5 most days. That's the best way to get through to me. I think the website is because there's every way on there. And what I'm hopefully incorporating shortly also is on that website. It's very basic. It's just really a funnel page, a hello page, if you will. But I'm going to incorporate soon an AI. It's like I'm downloading my brain and I'm putting it into AI right now. And so there's going to be a button there that you can press where if someone's not quite ready to get on the phone with me or book a time to get on the calendar, which I encourage you to do anyway, I don't bite. But if someone just wants to delve in a little deeper on a concept, I am trying to take as much of my brain power and put into this AI so people can chat with that AI and they can ask it questions. They can ask about a specific strategy or what other strategies we might be able to offer. And maybe someone can figure out if we're a good fit for them and then get on the calendar and then book time to talk to us.
Awesome. So Aaron, sometimes I refer to as a mic drop question. It's hindsight 2020. You've been doing this for a while and you have explored and expanded and made adjustments and shift to quote unquote get to a place where essentially you have it like here. You have it manageable, you are resourceful, and most importantly, you're educated in the subject matter so you can give people diversity of offerings, products, et cetera, to serve people, really serve and help people. So my question to you is if you had known like the stuff that you know now when you first started, what would you have done differently?
Well, what comes to mind is maybe a couple things, but to keep it short, I'm just a voracious connoisseur of podcasts and books, white papers, and I'm all interested in all things financial, right? It's just fascinating to me. And in my time, I've listened to people talk about, hey, we've got a great book, or we got a course or something about how the wealthy invest. And that was always so interesting. What I've learned is that, and I literally heard a podcast talking about this like last week, talking about famous American family that, oh, we're investing like this way, and I'll teach you how we're investing their money, and then you can do it too. For most people starting off, especially, or for young people starting off, that really doesn't matter. And that's because you are not, and I wasn't that way either, and I should have known it, and I wish I had known it, that I didn't need to know how to earn 2% above the rate of inflation because I didn't have $1 billion to invest. Okay? When we're young, we have to take bigger risks with less money. And then eventually, hopefully things work out for us well and we do well and we're focused. And then eventually we can take less risk with a lot of money. And I would tell people you have to, especially when you're young, and especially if you're looking to grow your wealth, you have to look outside the box. You can't just think, oh, I'm going to go get my 401k, which everyone should. And you should put money in your 401k or your IRA. Yes, you should, but you have to realize that the buck doesn't stop there. You can go so much deeper. There's so many strategies out there that people just think, oh no, I don't need it. There's nothing else to see. It's too good to be true. There's so many financial strategies out there. There's so many things to do beyond just setting money aside in your IRA or your 401k or something like that. I encourage people to, like, with both eyes wide open, go find those other strategies. Start thinking outside the box. And don't just think, okay, I don't know, I'm going to invest like the Rockefellers do and I'm going to earn 3% and that's how I'm going to get rich. You're not. You got to be willing to work hard when you're young, find those strategies. You have to work really hard when you're young. You can work less when you're older because at that point, like I said, hopefully you have a big bucket of money. You don't have to earn as much then. But when you're young, I wish I just would have focused on not just thinking, okay, I listened to a podcast, I watched a show, I know what to do, and close my eyes to what else is out there.
Makes perfect sense. Perfect sense. So, Aaron, I want to thank you for taking time out to be on the show with us today. I want to thank you for sharing the strategies that you've shared and giving that insight and introduction into more creative ways, if you will, to increase your wealth or to begin to establish wealth. I am over here straight, like in my mind process. I'm like, oh, wow, I didn't think about that and things of that nature. I definitely, to our audience, guys, you guys need to reach out to Aaron, connect with him, and see what it is that you could be doing differently in order to catapult yourself, because he's already giving you the launch pad. He's giving you the trampoline, guys, and we ain't got to jump on it for fun. Let's jump on it with purpose. So that blows me away. So, Aaron, again, thank you so much for being on the show with us today.
Thank you for having me.
So for our listeners, guys, look, you have, quote unquote, had your socks knocked off today with this content. So please do what I always encourage you to do, which is to make sure that you not only engage, but you act, that you put it into action so that you can change the trajectory of your life and impact, again, your family for generations to come. For our newest listeners, for our old listeners, look, this is how we get down. You guys know how I feel and you know what I say. I always put the two of those things together and I deliver it to you this way, which is to tell you that I love you, I love you, I love you, and we're going to see you guys out there.